Alright, so now let me offer the entire explanation about cost of redeemable debt. Please carefully understand this point. When do we say that a debt is redeemable? When at the time of issuing that debt, you have promised the counterparty that you will redeem that instrument, you will redeem that debt after a certain point or at a particular point. For example, if I am issuing debentures stating that these debentures shall be redeemed after 5 years from the date of issue, that means that debentures are redeemable exactly after 5 years from the date of issue. The redemption period could be 5 years, 10 years, 8 years, 15 years, 20 years. Any specified period will make it redeemable. If I say that I have issued debentures, I have not specified when they will be redeemed, it will be implied that these will be redeemable upon the liquidation of the company, and we would be classifying the same under irredeemable debt. Now, how to compute the cost of irredeemable debt, we have already learnt in the earlier part of the sessions. Now, here we are discussing how to determine cost of redeemable debt. So, there are multiple ways in which you are supposed to make this calculation. So, there is a traditional method also known as an approximation method, and there is a modern approach which is considered as YTM approach. YTM stands for yield to maturity. Because these terms are new for you, don't get worried when you are not able to understand what I am speaking, because gradually everything will be lined up and clarified. Keep a lot of patience when you are dealing with this part with me. Now, we are talking about cost of redeemable debt. First thing, interest paid on any debenture is definitely part of the cost. We have learnt how to convert the interest amount into post-tax by applying within brackets 1 minus t. When you apply within brackets 1 minus t, the pre-tax portion of interest gets converted into post-tax. We have learned the logic about what when you are issuing a debt instrument and you are paying interest thereon, that interest is not your cost, because whatever interest you pay, some portion of tax you will save on that expense, because your profit will actually come down. Without that interest component, your profit would have been more. With that interest component, your profit will be less. As a result, because of the reduction in profit arising because of interest expenses, you end up saving substantial amount of tax on that profit. We have learned that. Therefore, the real outflow is not the interest amount, but the post-tax portion of that interest. Now, what happens in case of redeemable debt? There will be one more component of cost that would come up. Just imagine that I have issued debentures of rupees 10 lakhs and promised that these debentures will be redeemed after 4 years. These debentures will be redeemed after 4 years at 20% premium. That means at the time of issuing the debentures, the proceeds in my hand was just 10 lakhs. But when I repay it after 4 years, I will not repay 10 lakhs, I will repay 12 lakhs. We will consider that 12 lakhs as redeemable value. Now, logically, if you think redeemable value and the net proceeds, these two amounts are different. When I collected the money, I collected 10 lakhs and I am promising to pay back 12 lakhs over and above the interest that I'll pay. Suppose these were 9% debentures, then every year 9% of that 10 lakhs of nominal value I will definitely pay as interest. Over and above that, I am giving you one extra benefit, that I borrowed from you 10 lakhs and I am repaying you 12 lakhs over and above the interest. So, don't you agree? If that is an extra benefit for the debenture holder, it will be an additional cost upon the company. As a result, what will happen to the post-tax amount of interest, or simply you can say to the amount of interest, you should add the component of expense arising because of redemption of debentures at premium. And how would you do that? 12 lakh is the redeemable value. 12 lakh is the redeemable value. From that you subtract 10 lakh, that was the net proceed. So additional cost upon me will be 2 lakhs. That 2 lakhs of cost doesn't arise at any one particular year. It will be spread over the life of the debt. If the life of the debt is 4 years, you will spread that cost over 4 years. Therefore, you would find that when we write up the formula of cost of debt, that is cost of redeemable debt, apart from interest cost, there will be another factor of cost, which within brackets we would write as RV minus NP. RV stands for redeemable value minus NP. NP stands for net proceeds. In my example that I am giving you just now, RV in that example was 12 lakhs, NP was only 10 lakhs. 12 lakhs minus 10 lakhs will give you additional cost of 2 lakhs, which must be spread over 4 years. So 2 lakh has to be divided by 4 years. 4 years will be considered as N as per the formula. So the additional component of cost that comes up will be RV minus NP divided by N. Now in the denominator, we cannot take 10 lakhs, we cannot take 12 lakhs because 10 lakhs was initial value, 12 lakhs was redeemable value. We are going to take simple average of the initial value and redeemable value, or in other words net proceeds and redeemable value. That is why in the denominator, in the formula you would end up writing RV plus NP divided by 2. When you do apply that formula, the resulting cost of debt would be the cost of debt as per approximation method. And friends, I told you, listening to me right now, writing notes, everything doing will still not give you 100% clarity unless you have taken at least one calculative example. Once you take one calculative example, task will be done. And therefore, I have asked you to maintain patience. So what I'll do is, I'll take you through some important notes over here, and I would want you to note down everything. If you don't understand any particular matter over there, I have requested you that keep patience. By the time we solve one important question, you will be having 100% clarity. That is my assurance. So let us first go through some important notes, and then only we will be taking up questions for solving. So under the heading cost of redeemable debt, please write cost of redeemable debt can be determined by using two different approaches. Number one, approximation method. Within brackets you write two versions. There are two different versions of that approximation method. And number two, YTM approach. YTM stands for yield to maturity. Let us move ahead and write further the approximation method. Now here what we do is, post-tax KD can be directly determined by using this approximation method formula. The logic behind this formula partially I have explained you, and in the complete notion you will understand when we are taking calculative examples. But if you still would want to understand something, the first component of cost of debt in this formula is interest into 1 minus T, that indicates the post-tax component of interest cost, plus the second term over there is RV minus NP divided by N. Some time back I gave you an example where net proceeds were 10 lakhs, redeemable value was 12 lakhs. So you are taking from debenture holders proceeds of 10 lakhs, but you are promising to repay an amount of 12 lakhs. As a result, you are giving 2 lakhs extra. That 2 lakhs extra will be spread over the life of debentures, that will be 4 years as per the example that I have given you some time back. So when you put it in the formula notation, it should be logically 12 lakh minus 10 lakh divided by 4 years. And when you put it in these symbols, it should be redeemable value minus net proceeds divided by the life of debt, or RV minus NP divided by N. Now this whole thing should logically be divided by one single amount. But do you notice one thing? If you are issuing debentures at 10 lakhs and redeeming them at 12 lakhs, the value of that debt is not stable. It is changing, and therefore we are supposed to take the denominator as a simple average of these two values, that will be 10 lakhs plus 12 lakhs divided by 2, or you can write it by formula as RV plus NP divided by 2. RV is 12 lakhs, NP is 10 lakhs. Aggregate of these two and divided by 2, you will be getting the average value. So let us do one thing. Let us write up the meaning of each of these symbols. RV stands for redeemable value, NP stands for net proceeds, N stands for life of debt, and T stands for tax rate. Now I told you friends, complete understanding will be developed only after taking up a calculative example. Let us move ahead, and what we do now is we write up another version of approximation method, which indeed sounds little more logical, a better version I would say. Pre-tax KD should first be determined. It is similar type of formula, but do you notice interest is not taken as a post-tax, interest also is taken over here as pre-tax. The whole computation of KD is basically a pre-tax cost of debt. We would compute this, and then the post-tax cost of debt will simply be the pre-tax cost of debt into 1 minus tax rate, and the variables will be defined exactly in the same manner. Now here, what is the better advantage of applying this version of formula? I told you I will be explaining when I am taking calculative examples with you. Alright, what I'll do is I'll give you some differences between these two before we proceed ahead, so that you don't get confused with what are these two separate versions. Please understand this point very well. The earlier formula that I have displayed on screen, which I don't call a proper version of the formula, over there the factor of 1 minus t was applied only on interest, whereas when you take redeemable value minus net proceed divided by n number of years, that is also additional component of cost of debt, and logically as per tax law this is also allowed as an expense from taxation viewpoint. If that is allowed as an expense from taxation viewpoint, you would end up saving tax even on that component. So logically you should not just apply 1 minus t, the post-tax effect, only on interest. You should apply that on the entire component. So please understand one thing, the previous thing what we have written over there, I have discussed with you only because it is given in your ICAI study material. Otherwise I would have discarded that from our discussion completely. Because it is given in your institute study material, I am bound to discuss it. But this version of formula is a better version of approximation method. In your ICAI study material, they have given both the versions. I would not want my students to use that earlier version. My students should be using this version, the better version always. When you are supposed to apply approximation method, do this. But if at all you find some questions in study material solved using that earlier version, don't get confused. That is indeed not a correct version of the formula. This is the better version. I would want you to use this. I am sure you people have understood the difference between the two. In the first version, what we have learnt few minutes back, the tax benefit was taken only on the interest component. In this version, we are taking tax benefit on the overall cost of debt, which is more logical. In fact, I would say this is only something correct. However, these both versions of approximation method is still approximation. The true cost of debt can be determined using the concept of YTM, that is yield to maturity, and that is the modern approach. In fact, do you know one thing? Only in India, when you are dealing with Institute of Chartered Accountants of India, Institute of Cost Accountants of India, ICSI, when you are a company secretary exam students, over here in India we have this problem that these institutions are still lagging to and attaching themselves with these traditional approaches whereas we have better approaches now, something called as yield to maturity. Worldwide, these concepts have been discarded already long back, years back. I do not understand why ICAI is still sticking to that, and if it is still sticking to the older version, at least use the better version of formula is what I always argue, but they are not going to listen. These people, they are not able to understand what is today's requirement and draft the study material accordingly. Something which is outdated, still there in the syllabus. Something which is a wrong version of formula, still there printed in the textbook. And students unnecessarily will be carried away with those notions. The moment you step outside the boundaries of India, and if you have these wrong notions fit into your mind, you will be the ones who will suffer. ICAI is never going to suffer. They will never have any problem because they are the ruling authority. You, on the other side, should not end up suffering, and that is why you should be aware of what is right, what is wrong, what is preferred, what is not, and what is the status of concepts across the world. If you happen to read CFA textbooks, you know CFA Institute, origin from USA, you would read the first level of CFA book. When they come to the concept of cost of debt, the first thing they write in their book is wrong approach of determining cost of debt, and they give this formula. And then they mention what is the correct approach, and the correct approach is nothing but yield to maturity concept. Anyway, we are about to learn that yield to maturity concept also. So just pay attention on the screen. I'll take you ahead and explain the same over here. So let us move ahead and we talk about yield to maturity. Basically, yield to maturity is nothing but IRR, that is internal rate of return. So the yield to maturity or YTM indicates IRR of the debt, because the investor who is debenture holder has invested in this debt instrument. Whatever be the internal rate of return for that debenture holder will actually become the cost of debt for the company. But the rate of return of that investor will be a pre-tax rate. So the YTM, which represents IRR of the debt, will also be a pre-tax cost of debt. Now to simply convert that into post-tax cost of debt, what you will do is, to the YTM, you apply that factor of 1 minus tax rate. That's all. And how to determine YTM, we have already learnt the concept of IRR when we were learning capital budgeting. Same concept applies over here. Now there is one benefit of that approximation formula that we have learnt, and I am going to draw that benefit into our calculations when we move ahead.